Good afternoon and welcome to this ACT webinar on making working capital work for you in today's economic landscape. My name is Stephen Baisby and I'm a member of the Policy and Technical Department of the ACT. First, let's explain the technical points about our webinar setup. On your screen, you will see a menu bar across the bottom that allows you to open various windows. Move these around your screen, resize them or minimize them. The green button with a question mark on it down there is the help if you have any technical queries. Another button opens the Q&A window. You can send questions by typing in the Q&A window. Don't wait until the end to send in your questions. Just send them in as they occur to you. We're dealing with them at the end of the presentations. Our practice is that we do not disclose any of your names. I should add that recording this webinar will be available on the ACT website in 2 days' time, along with a separate copy of the slides. Total time for this webinar will be 45 minutes. Any questions unanswered at the end of that time, passed over to the presenter directly. Now, working capital is receiving more focus as businesses begin to find that circulating financing is becoming harder to access. This trend will continue as Basel III is progressively enforced up to 2009. Further consequence of the introduction of Basel III rules will be the credit charge for working capital finance will become more expensive. Today, Ernst & Young will discuss the need of cash culture in organizations to enable sustainable change to working capital. American Express will discuss how their payments lead to wholesale receivables and payables transactions. The webinar will comprise 2 presentations, first by Lloyd Gold for Ernst & Young, and then by Greg Morris for American Express. So let's get started with Lloyd.
Stephen, thank you very much. Good afternoon, ladies and gentlemen. My name is Lloyd Gold. As Stephen mentioned, I'm an Assistant Director in the EY Working Capital Practice, and it's a pleasure to be here and present to you. I'm going to cover a couple of themes. First is building a cash culture inside an organization and the reasons behind doing that. And then secondly, just touch on the evolving financial product marketplace following the dramatic impacts of 2009. So, moving on. Why is working capital improvements such a challenge to sustain? People put a lot of effort into enhancing their processes, building policies, putting in new systems, but yet if you look at the chart on the slide, you can see that there are very significant peaks and troughs that take place on a quarterly basis, particularly at the half-year point and circled in red between Q4 and Q1 at the end of each year as people drive to pretty up the balance sheet, some might cynically say. The extent of that, if you look at the cash-to-cash cycle across the top 500 companies in the US by revenue, is somewhere in the region of 10 to 20% fluctuation between Q4 and Q1. And if we take those size of those companies and we take the cash-to-cash cycle to be DSO minus DPO plus DIO, so your day of sales outstanding, take away your days payable outstanding and add back your inventory position, then you can start to get an idea of just how much cash movement is taking place. And some of the feedback we get from people doing these kind of activities or who suffer from companies doing these activities is that there's very aggressive collections, activity taking place. A lot of companies stop making payments towards year-end or even the month before year-end, and where channels are in place for inventory, there's quite a lot of channel stuffing that takes place. This sort of behavior at period end might generate some short-term benefit, but it's not healthy for long-term sustainable change. And clearly this has implications for both the cash management aspect and also cash flow forecasting. The main reason behind that is long-term sustainable change requires embedding a cash culture within an organization. This is not a simple task. Cash touches all aspects of an organization, even if it's not clearly recognized. Graphic below covers 8 points: the working capital cycles, policies and controls, ownership roles and responsibilities, targets and KPIs, incentives, reporting, learning and development, and tools. If I start with the working capital cycles, there is a clear need for the organization to understand the drivers of performance. And if I take that apart, what we're looking at here is working capital is not just a finance issue, far from it. If you look at the supply chain, the whole procure-to-pay cycle, or the order-to-cash cycle, this involves finance at the back end, but your sales organization, customer service, your fulfillment, manufacturing, procurement, and there needs to be real vision and clarity in how those processes work, where the stumbling blocks are, and more importantly, where the handovers take place and where responsibility and accountability needs to lie. So step one, make it clear to the organization how the working capital cycles perform and what people's roles are. Moving on to policies and controls, what's the governance structure? Who owns working capital? I think what we've learned is that the very best organizations keep a very close tab on working capital. They will look at it certainly on a quarterly basis, if not on a monthly basis, if cash is becoming more urgently required. They have very clear, distinct policies in place which cover a range of things, such as what are standard terms. If somebody wants to go outside of those terms, what's the authorization procedure and process, and what's the escalation path? If, say, your standard terms are 30 days, but you are being pushed to extend to 60, what's the cash cost service trade-off that needs to be in place with that? Who owns what aspect of the process? And typically you'd see either the FD or the CFO sitting on top of that, and then the other functions taking their role and position inside that governance structure in order to get a clear picture and have a robust discussion around what takes place there. Ownership, roles and responsibility. There needs to be clear ownership of working capital and the underlying process steps. As I said, working capital is not a finance issue. If you take the order-to-cash process, just because your aging is poor or your DSO is high is not necessarily a reflection of the collections function. Collections function is a tripwire which will surface if there is an overdue payment or if there is a problem with an invoice. But if you look at that problem, then it could be that you've delivered the wrong things, you've priced it incorrectly, the terms on the invoice are incorrect, or that it's been delivered to the wrong place. So at that point in time, the sales organization can be involved, the logistics organization, manufacturing. Collections surface the issue, the rest of the organization needs to help resolve it, and they need to understand what their role is and what their responsibility is. Targets and KPIs, how to set a reasonable target for an organization, how to measure it. I've been in working capital now for 20 years. There are hundreds of potential metrics. Applying those in a sensible manner, so specific, measurable, achievable, realistic, and targeted, is key. Otherwise, the organization becomes swamped. I'll touch a little bit more on this on the next slide, so I'll move on to incentives. Incentives need to reflect the importance of cash to the organization. What are the key drivers of an organization's strategy? If it's purely driving sales, then it's likely that cash is going to be forgotten. There needs to be a real balance in how to ensure that cash is on people's minds and is starting to be built into the DNA of the organization. An example might be driving the sales organization to more effectively agree, negotiate, and ensure that customers adhere to terms, and therefore you could set some targets and incentives around how a salesperson goes to market, how effectively they achieve the organization's agreed terms, and also that they actually receive any sales commission when the payment is received as opposed to when the revenue is recognized. Consistency in reporting is key. It's a broader and broader, more global world, and there is no use in having a situation where your aging, for example, is calculated on invoice date in one country and due date in another country. The two simply won't align. You can't compare the two. You need to have that sort of consistency of reporting across the organization. And I think in some of the best organizations, that reporting is visible, and there's an element of internal challenge that takes place in order to make sure that peers are being kept on their toes. Learning and development, probably one of the most overlooked areas. We have a more complicated world now. We have very sophisticated systems. We have web-based systems, cloud-based systems, and companies are adopting different structures for these. If I again look at the sales organization, they need to clearly understand their role through training in this new world. They need to be the drivers of the people who are onboarding new customers and new clients. And by that, understanding and agreeing with them how and when and what goes inside an invoice, what tools are going to be used, what requirements need to be in place. As a very large global tech organization, if you don't have your invoice in by the 15th of the month, you won't be paid for an extra 30 days. It's in their terms and conditions. It's absolutely clear. However, I've seen many companies who deal with them not actually fulfill that, and they wonder why they're getting paid 30 days late. The individual needs specific role training. So what you provide to procurement or to operations is going to be very, very different to what you provide to collections. But all are key in terms of managing the end-to-end process. And then use web-based technology to ensure knowledge sharing is effective. That can be for forums, that can be for training material, or techniques and system functionality. Finally, a set of tools that make life easier. Dispute management comes to mind in the orders to cash process, how to surface, classify, resolve, escalate, and finally get payment for a disputed invoice. How to focus your staff more effectively by using segmentation techniques to identify who the key suppliers are or who the key late payers are. Or on the inventory side, where your key demand is, what your safety stock should be, etc. So making sure all those tools and techniques are in place. That touches, I think, on just about every aspect of an organization. And I think if you really want to drive sustainable change, all of these factors need to be embedded and put in place. If I think of one particular organization who embarked on the working capital trail back in 2003, the Greif organization, very basic product, 55-gallon steel drums. If you go to their website and look at the Greif way, right at the heart of the green triangle, you'll find working capital because it is critical to their ongoing health. They regard effective working capital and optimized working capital as being a key measure of their organization and helping to drive cash flow from operations. I just want to touch on key performance indicators and getting the balance right. I think it's very easy to over-engineer KPIs and reporting. Sitting down with one finance analyst in a shared service center, he bemoaned the fact that he spent days and days producing a very large book on a monthly basis. It was about 1.5 inches thick in paper, and nobody was reading it, or that was his concern. We challenged him not to actually produce it 1 month and see if there was any reaction. In fact, nobody actually noticed that the book had not been published. And the simple reason for that was he had done a very thorough job in covering every single base It's just there was too much information. We break it down into three areas. The ability to monitor working capital, so you're looking at overall performance, effectively an executive dashboard. Then to understand it, so drill down. This is where management comes into play, the underlying managers of the process. So you take your DSO and decompose it into weighted average terms, weighted average days to collect, and the aging. And then influence, the value creation aspect. That could be your top 10 lists, your underlying disputes. It's effectively the detailed operational metrics and supporting analysis that looks at the root causes and helps identify any potential opportunity. An important one to get right if people are really going to buy into it. Now I'm going to move on to the evolving financial marketplace and just touch briefly on this because I think it's interesting to see the way this has evolved over the last 5 years. 2009 saw a lot of organizations face the fact that their overdrafts were being reduced, their access to the debt markets was restricted, interest rates were cheap, but if you couldn't access it, it was a problem. And it's been interesting to see the way that new entrants have come into that marketplace. And just looking at the US market to start with, these sort of smaller, these new entrants have gone from virtually at the zero position in 2010 up to about $9 billion in 2014. And that's actually predicted to double again during the course of this year. The driver of that has really been, I think, first of all, access to funds. Very easy approach to doing business. Instead of filling out multiple forms, a lot of online web-based tools that enable them to make decisions much more easily. And interestingly enough, that's also been reflected very much in the UK as well. So from 2011 to 2014, we've gone from 0 to 2 billion. Neither is a huge part of the market, but it's a significantly growing part of the market. And think, organizations like Trade River, who are using letters of credit, they take you from a 12 or 13-step process of completing banking or traditional documentation to an online process of about 4 steps, and then the money is available. This sort of speed, effectiveness, customer friendliness is having an ongoing impact in this area. Looking at the range of new players, so if we start off in 2007, we've got the mega banks, the community banks in the US, the non-banking institutions such as Amex, and Greg will no doubt discuss that more in detail, and some initial technology providers, so your Prime Revenue on the supply chain finance, Ariba, and then this constant drumbeat, and this list is not exhaustive, of new entrants, Tualia, Kpis, Upstart, even PayPal. PayPal providing working capital to smaller businesses came to the market in 2013. Kpis, they're using non-traditional data for credit assessment. So they're going to places like eBay and looking at feedback and reviews and going to Amazon and other organizations and taking a very different view on credit itself. Looking at the UK market, again, market landscape in 2007, the traditional banks, an initial emergence of some of the technology providers such as Tungsten and Receivables Exchange. 2-3 more new banks, so Aldermore, Challenger Bank, Metro Bank, Shawbrook, all appearing. Another C2FO in the US, Platform Black in the UK, again Kpis appearing. It's a fascinating time to actually see the challenges being in place on elements such as overdrafts, factoring, invoice discounting, and seeing what the new technology can actually bring to play. At that point, Stephen, I'm going to pass back to you.
Okay, thank you, Lloyd. What we'll do, we've had some questions come in, but I think we'll ask Greg to make his presentation, and then we can summarize the questions at the end if the questions themselves are not answered by the presentation. So Greg, over to you, please.
Thank you, Stephen, and good afternoon to all the attendees. So my name is Greg Morris. I'm a Senior Manager here at American Express in London, and I specialise in our working capital team. What I was going to do today is take you through, I guess, a bit of background around how American Express operates within this space, tying into some of the commentary that Lloyd has gone through, how we see things currently within the marketplace of the UK. And also I will be going through in some detail a case study and testimonial client for us, which is West Coast Limited, which hopefully some of you will be aware of as a company, and then just taking you through some detail on that and obviously answering any questions should they arise. So if we move on to the first slide of my presentation. In essence, American Express traditionally is a provider of travel and entertainment solutions. In recent years, we've looked to diversify our product and service offering to really focus on how can we make a play within the business-to-business transactions arena. Our solutions are fundamentally focused around two key objectives that affect companies today, which is the improvement around DSO metrics, and also similarly the improvement for DPO metrics. And what I'll do is take you through some examples around how we can structure our solutions to look at both sides of the coin, as I term it, focusing on how can we look to reduce DSO, improve credit collection processes, help companies alleviate headaches related to late payments and delinquent payments from customers, and overall increase the working capital model and efficiency. Then also we'll look at a specific case study, as I mentioned, for West Coast, which will focus on some of the products they use to help increase DPO in line with the commercial pricing and structure that we've put forward for them. So if I touch on the next slide. Effectively, from our perspective, we like to position the benefits from using American Express solutions relating to DPO and sort of putting them in set categories. So for us, really, we look to guarantee an extension on any existing arrangement with your suppliers for a one-off transaction fee. Now, there is flexibility around what we can offer, so we can look to extend term arrangements from anywhere from 45 up to 90 days, and that will essentially depend on the current fiscal position of the company, what the overall potential volume of the program would look like. So it's flexible in both in terms of from a customer perspective, and also we can look to extend that period right up to 90 days, depending on the current situation the company is in. We look to offer supplemental credit facilities. So as you're probably aware, we are no longer a bank. We are not a primary lending organisation. American Express very much wants to position itself in the marketplace as a flexible supplemental, I guess, bolt-on facility to any of your existing treasury and banking relationships, and really, I guess, positioning ourselves as a solution which could be used to sit alongside and in tandem with any existing banking relationships that currently are in place. The products that we look to set up don't have any ongoing management fee or setup fees. We literally look to make our revenue from a one-off transaction fee, which I will discuss in some detail in a second. But effectively, those costs are related to the potential volume of a program, how much you want to put through, and what returns that you'd be looking to achieve. The simple premise around how we look to improve DPO is by offering a product where we would look to settle with any selected supplier, look to settle that payment in the existing arrangements that you have with them, and then we provide the term benefit to yourselves. Effectively, we are the payment vehicle which is replacing a typical CHAPS, BACS or cheque process for settling of an invoice. What I will do in a second is touch on a case study example, as I mentioned, for West Coast Limited, who are the second largest IT distributor in the country. They use one of our particular products in this shape and form, and hopefully that will give you some context around how it would actually look in a real-life working example. If we just move to the next slide, I've put a graphical representation just to put a bit of context around what I've mentioned there. So if we were to look at a current arrangement, say for instance you're settling an invoice on 30 days receipt of invoice, we would look to potentially extend that by another 90 days for a set associated cost, which would then ensure that the supplier is paid in the existing arrangement, so it doesn't affect your current terms with them, and then you would be settling direct with American Express at the end of that 120-day period. Hopefully that gives some context around at a very high level, what we can offer. We're looking to, I guess, support DPO improvement initiatives. We speak to customers on an individual basis based on price and what their preference would be. And as I said, we have flexibility on how long a term we can offer in terms of that improvement. Moving on to the next slide, and as I mentioned, sort of turning to the other side of the coin, Lloyd mentioned earlier around looking at the focus on DSO and how does that align to the efficiencies of the collection function, and how can potential organisations look at moving that average term of age debt. And what we look to do with our clients is effectively guarantee a form of payment as soon as our product is charged. We want to, I guess, create a additional credit facility and headroom within your customer base. So the example that I'll touch on for West Coast has got some fantastic working examples of how that has occurred. And effectively, we're trying to not replace or take over the credit collection function, but just support initiatives that make it more efficient, and also look to mitigate some of the risk associated with late payment or delinquent payment from customers. And I think, from my experience, having worked at Amex for just over 10 years and speaking to clients on a regular basis, there usually is only a small selection of those problem customers who regularly look to settle beyond their terms, or I guess represent a higher or heightened level of risk to the company. But really, our solution is designed to support, I guess, driving efficiencies around those type of examples. So if companies come to mind and you think there's definitely the opportunity to alleviate potential headaches, that's also where we can come in and sort of make a play to support you with that. What we also look to do is where maybe early payment discount structures are in place, if you're, I guess, wanting to bring cash within to the business in an expedited fashion, we're always interested to discuss that with potential customers and clients, because it could be that we offer a cheaper option than what is being offered in terms of a discount structure. And we can look to structure these deals that we set up in various different ways. There's many facets to the existing arrangements we have with clients, and I think that's the key thing, that we have flexibility to exert and design a solution that would work for you and your customer base. So just moving on to my next slide, this is a case study, a working example for a client which I set up and ongoingly manage. And I've been working with West Coast for just over 2.5 years now from our first introduction. As you can see from the slides here, I work closely with the owner and chairman, Mr. Joe Himani, who was really the key stakeholder in these discussions. West Coast, and I will touch on this in a second, but just before I go on to the next slide, they effectively use our products to settle with key global and multinational suppliers to extend their terms, support their working capital objectives, and also to align to their business model, which is effectively wanting to buy products from manufacturers and sell to resellers and end users, using our products to support the fact that they will be claiming their money in for the sale of those goods before they necessarily have to pay the suppliers for that. So it's a very simple wholesale and distribution model. We are by no means the primary lending facility in place with West Coast, but we do provide a very flexible and, as I mentioned, supplemental tool to support them at their peak purchasing periods. So if I move on to the next slide, it gives a little bit more detail around this working relationship with West Coast. So effectively, we launched an initial program with them at the end of 2013, which was focused on providing a 60 or 90-day extension for their expenditure with certain suppliers. We had great success in terms of supporting them with quarter-end and year-end deals, particularly at their peak period. And that relationship then evolved and developed to also focusing on their customer base, and how could we support them in terms of some of the key DSO metrics that they were looking to improve, and also alleviate a couple of potential headaches around customers who were regularly sort of missing their payment terms, and also looking to support them on growing their customer base in terms of providing additional credit facilities. So as it currently stands with West Coast, we are in the process of getting to around 65 to maybe 70 of their customers settling on American Express, multi-million-pound transactions going through each month. We've taken some time to really, I guess, create the inertia around this, but now that we have these volumes, we're seeing significant impact to their actual BSA metrics. We're supporting them with trying to increase growth within the IT distribution channel, and what we're also able to articulate with them is that we have seen a significant increase year on year from the customers who are now using the American Express facility to what they were spending with West Coast before. So we're really looking to channel spend to West Coast from other distribution partners. We're supporting them on the DSO metrics they outlined to us from the first initial meeting, and we're also supporting them in line with their credit insurer, Kpis, to look at providing extra credit headroom to their customers. In terms of the next steps with this partnership, I think the key thing is to continue to support the growth of their customer base through the channel. We obviously are looking at the commercials behind the deal, because as the program grows, American Express wants to remain competitive and keep them as a valued customer. And I think the key thing as well to mention here is that although West Coast is a testimonial case study that we can talk about in a public environment, we do have a number of these type of deals of a similar size and I guess scope, which we're hoping to be able to broadcast to the wider public in the near future. But that said, if there's attendees on the phone for companies and they're thinking, well, perhaps we're not of the size of West Coast, or perhaps we're even a lot larger than a company like West Coast, we work up and down the supply chain with the small SMEs through to mid-market enterprises, right up to your global and multinational companies. And I think the key thing here is that what, from my perspective, I want to position is that American Express is very open to working with all types of companies and looking to support them in some of the objectives they may be trying to drive around creating a more efficient working capital model. And obviously, we would welcome the opportunity to speak further with you. So on that note, my details are on the following slide. If anyone wants to, obviously, contact me or my team directly. But what I'll do now is just pass back to Stephen to, I guess, summarise for the end of the presentation.
Thank you, Greg. Pardon me. We have had a couple of questions come in, and I think first, probably slightly thrown people by the US example you're using on your slide, but of course this is operating in the UK at the moment, isn't it? With West Coast.
Sorry, Stephen, my apologies. Your line cracked at the end of the question. Would you mind repeating that for me, please?
Yep. This system, West Coast, are operating in the UK at the moment using the DPO system, not? That is
correct. Yeah, that is correct. Although what I should point out is that our solution is we have the ability to settle in any denomination. So, in fact, West Coast will be settling. I won't name the name of the supplier, but it's probably pretty obvious. Once I've said they're a European-based manufacturer of IT equipment, and we're settling for those invoices in euros. So initially the program started just in sterling to UK suppliers, but it has actually now progressed to euro, and we will actually be moving into potential dollar payments in the near future.
Right. And if we could go back to Lloyd's presentation where we were discussing why should we be concentrating on working capital. The question came in, Lloyd, that working capital structure and window dressing is always a risk that we become accused of. And I think what we're recognising is that really we're not looking for just periodic reporting benefits. We're trying to look at long-term benefits, objective working capital management.
Yes.
The benefit of reducing debt and reducing interest in a sustained way. As a policy and technical person, of course, I'd also like to point out a factor which can often get lost in one's dealings with one's banks and financial covenants is that financial covenants are often ongoing. They're not just periodic. And the temptation to window dress is always one that we have to watch. And that if you suddenly get called to have to report your ratios at a different date, it can be a little embarrassing if they are somewhere off the covenant levels. That, of course, is for businesses which are a bit in the extreme.
If I can just interject, I mean, you made the point about debt, often a driver of a working capital program. I think each company may well have or type of company may well have a different driver. One of the retailers embarked on a working capital program which they translated into 46 new shops. So that was brand increase, that was footfall increase, and that then helped drive a much more effective CapEx program.
And come back to you, Greg. One point, obviously, you represent American Express, and you're presenting how American Express does this, but this is part of the process we're seeing where really new sources of credits are coming into work against traditional banking markets. The process here would effectively provide an extension of credit available through a new source which most people wouldn't have thought of. And I should emphasize here, this is a wholesale type of transaction. So it's given the ability to generate six-figure payments quite easily. And I believe, Greg, using card technology in your case, and larger amounts could be generated using more internet portals. Is that correct?
That's absolutely spot on, Steve. So, I mean, if I refer back to the West Coast example, obviously, because I can talk about it. So the majority of their customers are average transaction of, say, about £300,000 to £500,000, and they all use a card platform. If a specific card that is locked down for sole use with West Coast to eliminate fraud or any other transactions going through. The West Coast themselves, when they're settling with some of these manufacturers, are settling for potentially £10 million or €10 million plus at a time. So we use an internet-based portal which has a few more, authorization levels just because of the figure that is involved. But effectively, both solutions are just replacing typically a BACS or CHAPS process, and in terms of how long they take to initiate payment, it's almost exactly the same sort of time frames.
And where you are acting to facilitate the receivable into your clients, the question has come up as a point where effectively your party using the ability to pay, in this example, West Coast, who's taken the credit risk at that point of the transaction? Is that you as the credit provider, or is that still passing back to the West Coast, in this case, the customer?
No, great question. So it's us. So effectively, as soon as our card product is charged, we take the liability. Obviously, we look at underwriting the individual customers, and we will then deem an appropriate limit, credit limit for them. As soon as the card is charged for anything up to that limit value, then we take responsibility for that payment, and that debt passes over to Amex. So when I talked around the credit collections process and guaranteed form of payment, it's one of the key reasons companies like West Coast look to work with us, because they might have a customer where they have an insured limit. They might have a slight gap where they're taking what I would call a punt, an uninsured credit line, and we can alleviate some of those potential headaches and remove that.
Okay. And very topical at the moment with all that's going on with PSD2 in the European Union, where the interchange fees are beginning to be affected and the ability to reach charge fees. But card transactions immediately bring to mind high merchant fees. How are these managed within your process? Who is bearing that fee, and is it a pure ad valorem fee?
So just so I'm clear on the question, sorry, Steve, are you asking in terms of our transaction fee, how does that look, and how is that processed?
Yes, how's the process? Who's paying it? What's the basis of it? Because the question that's coming is clearly concerned that you're paying sort of a 2-3% handling fee. For sure. And this is one of the key reasons we're looking to sort of broadcast on this type of medium and really, I guess, re-emphasise that
as a business, American Express traditionally is seen as a 2.5–3% fee, which, let's just get this off the table. That is not what these type of discussions commercially are around. We have to be highly, highly competitive with the various banking and network providers. So I think in terms of, whilst I wouldn't discuss particular numbers on this call, I think let's presume that from a commercial perspective that the fees are more in line with typical bank lending rates and working out weighted average cost of cash for the year. Obviously, we're keen to have individual discussions with customers, but I think if you can look at a company like West Coast, who have an average margin of 3.5% to 4% on what they sell, a £2 billion company nearly, we created a commercial agreement with them where they were prepared to absorb our fee in its entirety. So on both aspects of them accepting and using our product, they pay and wear the rate. So hopefully that should give some comfort to the attendees on the phone that if you were to speak with American Express and look at the solutions we can offer, I would position them as highly competitive in terms of pricing. That said, that is only a transition really that has taken place within the last, I would say, 36 to 48 months within the business, but that has been the change and alteration that we've had to take to remain competitive in this space that we now want to enter and provide solutions for.
Good. So we can sort of reinforce by saying this is not another purchasing card. This is an extension into the non-banking market of credit, wholesale credit, to facilitate receivables, payables. One of, as we saw in the earlier presentation, quite a few sources of this kind of credit which are coming into the market, and not to be confused with the standard T&E card. Now, we've been asked to conclude now. Any more questions which remained unanswered, we'll endeavour to have answers rooted, of course, to retain anonymity back through the ACT's technical service. But what we would like to do is wrap up. First, thank Lloyd and Greg and Ernst & Young and American Express for their presentations. I'd like to thank everyone who joined today's session. I'm sorry if we didn't reach your question with our loss of time. We'll handle that separately. As I mentioned at the start, we will be putting up a recording of this webinar on the ACT website, along with a presentation in 2 days' time, and we will be sending you all a link to that. Looking forward to the rest of the year, our future webinars can be found on the website, treasurers.org. The next webinar will be the impact of tax and regulatory changes on the Treasury function, and that will be on the 7th of July. Thank you for listening. If you can spare a moment to provide feedback on the webinar, we'd be very grateful. Just select the feedback widget in red on the bottom bar. The facility to do this will remain open for a short while after the webinar ends. From all of us here, thank you and goodbye.